Yeah, so Mogo Inc., symbol Mogo or MOGO on both the NASDAQ and the TSX, is a Canadian fintech company. The company operates a stock trading app, Mogo Trade, as well as digital wealth platform. The company offers an automated flat fee investment service under a subsidiary, Moco. In addition, the company also offers digital loans and mortgage services to consumers. As well, under the company's Carta Worldwide subsidiary, the company offers card and payment processing programs. As well, the company owns 13% or 87 million shares of WonderFi, a Canadian crypto trading platform, as it owned shares in CoinSquare before those two companies merged. The stock is currently trading at 238 Canadian, down 26% over the past year. The market cap is 58 million Canadian at this time. However, if we zoom out, it's even been quite a bit worse. We've seen it fall over 90% from its peak in early 2021. I think it's even upwards of like 97% if you bought the very tip top. So it's obviously had a quite dramatic fall in the past few years if you were buying at that time. But how is it performing now? Looking at the last quarter, Q1 2024, the member count, so that's just users effectively signed up to their various services, has increased 5% to 2.1 million. Mogo had revenue growth of 13% to 17.9 million, of which 10.7 million was subscriptions and services, and the remaining 7.2 million was from interest revenue, growing 13.2% and 12.5% respectively. So about even growth between the two segments. The company's net loan portfolio, which is what relates to that interest revenue, less losses, or the net portfolio, I should say, increased by 1.3% to 62.5 million. So the majority of the interest growth was really just due to higher interest rates. Gross loans outstanding at this time, so that's without the expected credit losses, was 76 million. Adjusted EBITDA remained flat at $1 million. Adjusted net loss fell to 4 million from a loss of 3.9 million, so nearly the same as well. Adjusted net loss really removes the impact of their equity investments, namely WonderFi, as that is a substantial investment in their company or on their balance sheet, as well as it removes the stock compensation, as well as some other non-operating expenses. The company does guide the subscription and service revenue to grow in the mid-teens for 2024, which means assuming that the interest revenue stays roughly the same, you're not really seeing much change in their loans outstanding or their net loans outstanding. If that doesn't really change, you'd be looking at high single-digit total revenue growth, unless there's interest rate changes or they grow or shrink their loan book as well. That could change it. But I would say high single digits is a good benchmark figure for the revenue growth for the year. So switching to the balance sheet, the company is unsurprisingly a net debt position, as it does operate a loan service like a bank. And this is common. You of course take money in as bank, lend it out, and that's how a bank operates, and as well as effectively every loan service in some capacity is they'll have debt on the balance sheet and hope to loan out for a higher interest rate, and there's just net interest spread. So that's not exactly unsurprising, to say the least. The company does have 11.8 million in cash with 51.3 million outstanding credit facility. That credit facility specifically relates to that loan book. So that's the offsetting liability, and then the loans which they would be issuing out or lending out is the asset for the company itself. So 76 million, 51 million, they have about $25 million in net exposure to interest rates. In as well, they have 36.3 million in outstanding debentures and 2.6 million leases. So total, including that credit facility and leases and debentures, they have a net debt position of 78.4 million. The company's debentures carry a floating interest or carry an interest rate of 8 to 10%, and the credit facility charges SOFR, a floating rate, at that SOFR rate plus 8%. For the last quarter, the analyzed rate for the credit facility was about 13%, which is what you expect when you're paying plus 8% on a floating rate at this time. The debentures are due in 2025, which will require either refinance or they have the options to pay in shares. So that if that was elected to be done, you would see a dilution uptick quite a lot, as they have a $58 million market cap, $36 billion in debentures. You're looking at significant dilution if they went down that route. Not saying they would, but that is obviously an option, and that would be something you would want to merely pay attention to what they decide to do. The company does, however, have significant investors in crypto-related companies, notably holding 28 million in WonderFi, the Kevin O'Leary-backed crypto exchange, which we've previously done reviews of. The total cryptocurrency-related investments, which includes like Bitcoin ETFs and some other smaller companies, is 29.6 million, which of course they could be sold to cover the outstanding either credit facility or debentures if needed. And that is obvious an option. So really solvency or liquidity is by no means really a risk, but it's just interesting how you can see if they do what they elect to do can change the company's outcome quite a bit, as right now the interest expense does create a drag on earnings, but they do have the option to liquidate the WonderFi stock, and then they could pay down the debt in some way, whether it's the debentures maturing or if they just want to pay it down. That is obviously an option there for them. The company is offering a new service, which they just announced recently, a new stock trading platform allowing for direct investing with no transaction fees, but a $15 per month fee. So Mogo is calling this Buffett mode. Great name. And it is with the goal of reducing the gamification of investing. So like Robinhood, I believe, I haven't used it myself, but I believe they even have like fireworks or confetti fall down from this on the screen of your app when you're doing certain actions. Obviously, that's quite game-like, and that's what they're saying to reduce. But I want to point out the irony here is they have this kind of Matrix-esque font, and like the green with it seems a bit gamification to me there when you're saying you're trying to remove that. But I digress with that. As well, just on a bit of an aside as well for this, is they're saying they're doing the monthly fee because that reduces their own incentive to reduce them pushing trading onto clients. But then clients have the opposite incentive because they are trading, paying a flat fee, is they can take advantage of no commission fees past that and trade more. So you have that opposite side of the spectrum, where on Robinhood, they want you to trade as much as possible and accumulate other fees. But then the users, they can do a buy and hold strategy and pay your 0% commission, and then that's good for them. So you have opposite sides that are different. So you could end up seeing people who want to gamble more buy into something like this when that's what it's trying to get rid of. But I digress with that. It's a bit more on less to do with the company and more if you are looking to use the platform itself. But moving to valuation, as the company doesn't have net positive income and we really have to just rely on adjusted EBITDA, the company has a trailing EV to adjusted EBITDA of 17.8 times, which is not cheap for a fintech company at this time, and given their expected growth. But really putting it all together, the company is expensive given its current debt levels, although it is manageable given they do have the option to liquidate their investments if needed. It's a liquid market, it's a publicly traded company. They would probably take a bit of haircut because they do own 13%. So they obviously would drive the market down unless they could find a big block trade, which is always an option for these types of companies. But the company is just not near GAAP or even adjusted probability at the sign, even when discounting the financing aspect of the credit line, the debentures. They do create an overhang that will pull down the earnings with interest, expenses, or payments, or result in dilution down the line, depending on how they elect. I would honestly, at this time, choose for them to liquidate WonderFi. It doesn't really seem to fit with the sense of what they're trying to do. Is before they had a significant stake in Coinsquare, I think it was about 40%. So you had a significant nearly controlling stake in the company, versus now you're a minority shareholder. So I'd like to see them just clean off their balance sheet, clean down that, and then reinvest the cash, pay off their debentures, or just hold the cash and uh, expand their loan book or invest into other opportunities over just holding equity. Because I can do that as my own investment, especially when it's now a public company. If I want to own WonderFi, I can just go and do that. It doesn't make sense to me whenever you have these companies with their own operations, but then they invest an equity stake in the company when I can do that myself, unless they're getting something else additionally from it, which I don't see that in this case. But if you do have any thoughts on that, I would like to hear them as well. As well, I would like to see where that stock trading and the wealth management really grows to. They are pushing into direct investing, which is always, even as an aside, I like to see more platforms in Canada where severely lacking competition. You can look at your bank fees and see how much you're getting screwed over compared to American competition. And so, just even as a user, I would like to see that. I'd like to see it grow. But then, if you are looking at Mogo as an investment, that could be lucrative, as it is really an uncompetitive space in Canada at this time. Really, the only one-to-one comparison I would say is Wealthsimple at this time for that market that they are trying to go to. So by overall, the company by no means is a write-off, but it does need to really grow that bottom line to really support that current price, as it is an expensive valuation this time. So either EV needs to go, or EBITDA needs to go up, or EV or share price needs to really go down to really make it more of an attractive opportunity at this time.
Yeah, no, I agree. Again, it's just it's a story we keep harping on. The valuations are too high, and you talked about it. I agree too. The position they have in Wonderfly, I'd rather they just run the business, pay down some of the debt, and produce a profit that can grow over the long term. I mean, it's very boring, but it'll take care of itself in terms of the share price if they can do that. Right now, again, the valuations are too high for us to be involved with Mogo.
It's interesting how they can use like, or you know, term it the Buffett mode. I just find
Oh,
that's
I
interesting.
was going to
How.
say that because I know a couple companies that have even used Buffett's image,
Hmm.
and have been told to nicely. Apparently, he has the nicest law firm out there. Apparently, but it says please cease and desist. Right,
Hmm.
unless they're paying something for that, they have the image there,
Mhm.
and they have the name. Maybe they are. We haven't
Yeah,
looked into that. Right?
that's live on their website.
Yeah.
I think in a couple places they do put in quotations, as well as they have a ton of quotes from Charlie Munger as
Hmm.
well, Buffett, a few other value based investors, which we're gonna like. That's the same philosophy we obviously have here, but it's just
Yeah.
a bit weird when they're advertising in this sense as well.
Yeah.
Yeah, it's different. It's different, and maybe at some point it probably takes a while. Everybody's using Buffett's name half the time, but if you've got the image up there and you've got the name, you're calling it that. Perhaps there is a licensing there, but I don't really think that Warren Buffett does a ton of that. So, and I'd be surprised, but we'll
Hmm.
see how long that lasts or is able to be called that.
Yeah.